Hi, I'm Professor Ebert. I'm here to help you master it quick. In today's session, we're going to look at business transactions and the effects that they have on the company's financial statements. There are 12 basic transactions, and once you become familiar with those, the others are simply variations on the basic 12. Each transaction involves an exchange between the business entity and another business entity, or possibly a financial institution, or possibly an individual person. The key to understanding what the transaction does lies in understanding the accounts the transaction changes. Let's look at the 6 types of accounts that there are. As you can see, there are 6 different kinds, and the job of each account has a specific purpose. Asset accounts are meant to keep track of the amounts of resources that are available for future use by the business as it carries out its work. Things that will be included in the asset category are cash, accounts receivable, inventory if the business is a retail business, equipment and furniture that they use, anything that's prepaid such as insurance coverage, and some assets are less tangible in form, things like patents and distribution licenses. They have in common is all of them have future utility available to the business. Liability accounts. The job of the liability accounts is to keep track of the amount of obligation or debt the business entity owes to either another business entity or to a financial institution or possibly to a person. The hallmark of a liability account, in the account title it will say the word payable, meaning that there's a debt due. The capital type account, the purpose of those accounts is to keep track of how much the value of the owner's interest in the business is at a given point in time. If the business is a proprietorship, the owner will have one single capital account. In a partnership, each partner will have their own capital account. In a corporation, it takes a slightly different form. There'll be a capital stock account, a paid-in capital account, and a special account called retained earnings. All of them are part of capital for a corporation. The dividend account is used in a corporation to keep track of payments made to the shareholders that come from profits earned in previous periods of time. The revenue account is, the job of the revenue account is to keep track of the sales value of work sold to a customer or product sold to a customer during a certain period of time. It's the retail value of what the business has sold. And finally, the expense accounts are meant to keep track of the amounts of resources the business has used up in the performance of its work. Understanding the jobs of the accounts makes it a little bit easier to understand how the financial statements are put together. The income statement makes use of the revenue and expense types of accounts. The purpose of the statement is to show the results of business operations during a period of time. If the revenue exceeds the expense, there'll be what's known as a net income, sometimes called a profit. If the expenses exceed the revenues, then the business experiences a net loss. The balance sheet has a different job. The job of the balance sheet is to track the amounts of assets, liabilities, and capital or owner's equity that exist as of a certain date. The financial statement balance sheet will give you the firm's financial condition or financial position as of a certain date. The retained earnings statement is used only by corporations. The purpose of the retained earnings account is to keep track of the amount of profit earned in previous periods of time that was not paid as a dividend but rather kept inside the corporation. Proprietors and partnerships don't have a retained earnings statement, only a corporation does. And the job of the statement is to simply explain to you how the retained earnings balances change during a period of time. The cash flow statement has a different job. What it does is it explains the change in the balance of cash and what are called cash equivalents during a period of time. Most introductory courses don't tackle the job of making a cash flow statement because the statement is rather complex. It's usually handled in a course beyond the introductory course. But if the accounts used either had cash come in or go out, then the cash flow statement would get involved. Now we'll get a look at what the 12 basic transactions do on the company's financial statements. First, a couple of ground rules we'll have to follow. Behind me on the board is a depiction of the elements of a balance sheet. Every transaction that the business gets involved in will change the balance sheet. Only certain ones will change the income statement, and only certain ones will change the retained earnings statement, but every one will change the balance sheet. The reason why this is true is because changes to net income will also change owner's equity or capital in the same direction. Changes to the dividend account will do likewise, but for a different reason. So a dividend will affect only the retained earnings statement. Revenue or expense transactions will affect the income statement. Both of those kinds of transactions will also affect the balance sheet. Second ground rule we'll have to keep in mind is every transaction that occurs is going to change at least two accounts. Sometimes more than two, but always at least two. The third ground rule we'll have to follow is our changes will change the balance sheet on either side of the equal sign in the same direction and by the same amount of money. Ready? Let's have a look at the 12 transactions. The first transaction a business will get involved in is when it is first formed. The owners of the business will bring in assets to be used, sometimes cash, sometimes trucks and cars, sometimes equipment, as the beginning of the business, so there'll be assets there for it to carry out its work. The substance of this transaction is going to include an increase to the asset being invested in, cash, truck, what have you, which is one account which will be changed. Now, as we mentioned, we have to change at least two accounts. The second account is the owner's capital account, which also receives an increase. In the case of a corporation, it's done by the corporation issuing shares to the owner in the value of the asset that has been invested in. The next thing that the business has to do is acquire assets to increase the scope of the work that it can take on. There'll be three variations on an asset purchase, which we'll look at now. In the case of a small asset, this company might simply pay cash to get it. let's look at the instance of $100 worth of supplies. Okay, if the company buys $100 worth of supplies, the asset supplies will increase. If they paid cash to buy them, the asset cash will decrease, and the change will occur entirely on the asset side. Now, why is it still in balance? The reason it's still in balance is the change to the right-hand side of the equal sign is 0 because we didn't need to use any of the accounts. So that's why the balance sheet will still remain in balance after that transaction occurs. The second possibility would be a larger asset, and rather than pay cash before the work is done for the customer and we don't tap our bank account out before we have a chance to collect, we might ask the supplier if we can open up an account at their store and establish credit. Now, in a case like that, the company buys, let's say, supplies, but a larger amount. Maybe it's $2,000 this time. We open up an account, say it's at MAB Paint, and we're buying paint that we're going to put onto a paint job that we're going to do next week. So that we don't tap our bank account out now, we use accounts payable, which is in the liability section. So both of those increased by the $2,000, representing the job material supplies that we bought. The third case involves purchasing larger assets, in which case we might be financing a part of the purchase over a protracted period of time. Let's say that the company buys a truck. Say the truck is a $40,000 truck, and we put $5,000 down, and we put $35,000 onto a note at the dealer. That one will look this way. The asset truck will increase, the asset cash will decrease, and the note payable to the dealer will increase in the amount of $35,000. So equilibrium will be maintained. In the case of a very large asset, such as a building, it looks very similar. The building will be increased, the cash will drop for the amount of the down payment, and then mortgage payable will go to the liability section. When the business pays a liability, the transaction will involve reducing the liability account and also reducing the account cash. That one will appear this way. That $2,000 accounts payable that we owe to the MAB store, when it comes time to pay it off, when we pay the accounts payable, liabilities will drop. They drop because we issued a check to MAB, so our cash also drops. So both sides will drop by however much the value of the liability paid was. The business may need to borrow money to expand, purchase additional assets to do more work, and borrowing money from a bank or from some other financial institution is very much like buying the cash on credit. What will happen? The company's cash account will increase, which of course will increase the asset section. Then the liability to the bank, the note payable, will increase the liability section. When the note is repaid, there'll be a reduction to the note and also a reduction to cash. On larger notes that are paid over a period of time, there will also be an expense from the interest on the note, and that will actually go in here and reduce the owner's equity section. So paying a note like a truck note, where there's an interest component and a principal component, will actually reduce all three categories. When the business's owners decide to take a withdrawal, they'll make use of the drawing account or withdrawals account, which will reduce the capital section. And when they take out cash, they'll reduce the asset section as well. In the case of a corporation, it takes a very, very similar form. The corporation decides to declare a dividend by action of its board of directors, and that will have the effect of reducing the retained earnings account. The retained earnings account is part of the capital or owner's equity of a corporation, so it does the very same thing. And then when the dividend is paid, the corporation's cash is also reduced. A publicly traded corporation has an additional job. Ownership of the shares will change hands from time to time. So there will often be a lag between when the dividend is declared and when it's actually paid out. In a case like that, the declaration of the dividend will reduce the retained earnings, as we have shown here. And in addition, we will temporarily introduce a liability called dividends payable. This is because we have to find which shares have changed hands and find out the name and address of the new owners so we can send them their dividend check. When we send the dividend check, it's very similar to paying in accounts payable. We'll reduce dividends payable and we'll reduce our cash account. Next, the business is out and ready to do work. So every time they complete work for a customer or sell product to a customer, we'll have a revenue transaction. Revenue transactions will always increase the company's owner's equity or capital. The reason is because they're increasing the company's net income. Remember, net income and capital will both move the same direction. So when we go out and sell work to a customer, we're going to introduce additional net income, which will raise our owner's equity. The revenue transaction will bring us an asset. The asset will either be cash if the customer pays us upon completion of the work, or it might possibly be accounts receivable. Accounts receivables come about when we extend credit to the customer, let them open an account at our shop, so that they can pay us 30 days later. So in either case, there will be an increase to the asset section, either cash or accounts receivable. Once the accounts receivable is out there, the customer will have typically about 30 days to pay us for the work we did or the product we sold. Now, when the customer pays, the transaction to collect the accounts receivable is not a second revenue, but rather simply an exchange of assets. When the customer pays us, our cash will increase and the asset accounts receivable will decrease. So the transaction will affect only the asset section. In the case of an expense transaction, expenses are going to cause net income to decrease. That goes for any type of an expense that we might use. So every time the company incurs an expense, owner's equity will drop. Why? Because net income is dropping. So the drop to owner's equity shows like that. In a case of a small expense, maybe we bought gasoline for one of the trucks and we just paid it with cash, our cash will also drop. Same thing is true of any bills that come in the mail and we pay them right away, utility bill, phone bill, anything like that. Sometimes we have used accounts payable when we purchase the item. Telephone bill is a good example. Our telephone bill comes in the mail. It's not due for maybe a month, so why pay it sooner than we need to? When we record the telephone bill, we'll record the telephone expense, which will drop owner's equity. Now, if we haven't paid the telephone bill yet, we'll use accounts payable, which will increase the liability section. Later on, when it's time to pay the telephone bill, when we pay it, we will drop the liability and drop cash. Now that you've seen the 12 basic transactions, it's easy to see the account being used is what's giving us the financial statement change. If we used a revenue or an expense account, remember we changed the income statement, which meant we changed net income. If we used the dividends account, if the company is a corporation, we changed the retained earnings statement. Anytime we use an asset account, of course we're changing the balance sheet, liabilities accounts likewise. The account being changed is really what will give us the financial statement effect. To summarize, remember, our transaction always involved an exchange between our business and another business or a financial institution or an individual. Because of the exchange, there are always two accounts used, sometimes more than two, but always at least two. When we recorded it using accounts where we kept our balance sheet in equilibrium. Understanding transaction recording is the basis of understanding double entry accounting, which we will take a look at in a future session. Once you understand the 12 basic transactions, you're on your way to mastering it quick. I'll see you next time.